Thanks so much for joining us. Bonjour, bonjour à vous tous. My name is Rick Smith. I'm president of the Canadian Climate Institute. I'm joining you today from the traditional territory of the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat peoples. Welcome to this embargoed briefing of Power Play, how to supercharge Canada's clean electricity advantage. The study is being publicly released next Wednesday, June 17th. And whenever our institute releases major research studies, we like to have these embargoed Q&As to make sure that all of our key stakeholders, media, elected decision makers can absorb our research, get whatever questions that you have answered prior to this document becoming public. The Canadian Climate Institute has a broad mandate related to climate change mitigation, adaptation, clean growth, sustainable finance, Indigenous research. And we're particularly interested in policy solutions that contribute not only to emissions reduction, but to Canadian economic success and increased affordability for all Canadians. And done right, broad electrification can contribute to all three of these priorities. So as our country takes the next steps to that broad electrification, as the federal government works with provinces and Indigenous nations to finalize details of the newly released National Electricity Strategy, we hope that this new study from our institute is helpful in propelling our national discussion forward, in underlining some new best practices that can be expanded across the country, that can literally be built upon. I want to turn now to my very hardworking colleague, Kate Harland, our Institute's Clean Growth Research Director, who will lead you through a presentation of our results. After Kate is done, we're happy to answer any questions, soit en anglais ou en français. If you do have questions, either as Kate is speaking or in the Q&A session to follow, please just plug them into the Q&A box in Zoom. So thank you again for joining us, and over to you, Kate.
Thank you very much, Rick. And I'll be presenting today along with my colleague Iyab Al-Aini, who is also on this team, and we're joined as well by Marissa Beck and Nain Tarasudaka, who work with integral to this project. So I'd like to thank them all. And you're going to receive an embargoed copy of this report in advance. So I'm going to ask that you keep that entirely confidential until the public release of Wednesday, June the 17th. But that contains many more details than we can possibly present today. So watch out for that. Okay, so this work starts from the idea of opportunity, that investing in Canada's power markets today can leverage far greater investment in industrial capital, and at a time when we're really seeking to attract capital in Canada and diversify the economy in the face of deep uncertainty. And in parallel, we're seeing two structural shifts underway. So we're seeing one in demand for power and the other in the supply of it. We sit this time when access to power is emerging as a binding constraint for industrial projects, both here and abroad. And demand that has historically been flat has risen sharply, both as existing industries electrify and as new sectors emerge. Governments are looking to double the size of our electricity systems while still keeping rates competitive. And at the same time, we're also seeing that the prices of solar panels, wind turbines, and batteries are much cheaper than they were a decade ago. For example, globally last year, wind and solar met 99% of the net growth in electricity demand build-out. And this creates a new opportunity for a more distributed modular electricity system build-out to meet this need. Converting such an opportunity, even from Canada's strong starting position of a relatively clean grid, requires some policy action. And so we set out to answer the question of how we do this. It's no longer a question of whether we have to grow the electricity system, but how we do so competitively. And that means, what does it take to make modern electricity markets competitive? And how does policy need to evolve alongside that? We needed a framework that would capture the diversity of the Canadian electricity systems and also reflect on what it takes to compete internationally for investment. So we chose to look at 4 Canadian provinces and 6 international peers. We drew on literature, interviews, and an online survey to identify 6 indicators of a modern competitive electricity system. The result was a framework that tells us not just where Canada stands, but also where government should act. And it led us to policy recommendations that respect the different jurisdictional roles of federal and provincial governments while recognizing Indigenous leadership in this space. Today, I'm going to focus this presentation on our results and our recommendations for the federal government, with provincial recommendations to follow later this year. So the 10 jurisdictions we chose to look at in this study include the 4 largest Canadian grids: Ontario, Quebec, BC, and Alberta. And they represent together over 75% of all Canadian industrial electricity demand. And 6 international peers. So that's the UK, Germany, New South Wales and Australia, Norway, Washington, and Texas. And they were chosen based on their generation mixes, their market structures, and their size of their grids. We'll label some jurisdictions from here on in as hydro, where the hydro power capacity typically exceeds 60% of supply, and others as non-hydro. This is just a shorthand. In reality, there's some hydro in those other mixes as well, but they just have a more diverse mix in those other jurisdictions. So before we look at the benchmarking results themselves, I'm going to hand over to Iab for some contextual analysis for the project. Thank you.
Thank you, Kate. Because the focus of this project is on industrial customers, here we show how the industrial rates compare across all the provinces and international peers. And what we see clearly is that Canadian provinces overall have a competitive advantage when it comes to industrial rates. Quebec and BC are amongst the lowest industrial rates in this group. And then we see that Canada is starting from a very competitive place as we enter this era of growing demand. This chart also shows the impact of gas prices that drove electricity rates following up the Ukraine-Russia war, particularly in Europe. What we see here is industrial demand, both past and future. What's clear is that in all jurisdictions, the next decade is breaking from the past trend. The solid lines here represent historical industrial demand. And as we see what that looks like, some jurisdictions show flat demand, some modest growth, and in some cases, a decline in industrial demand. However, looking at the dotted lines, which are the projected industrial demand, all jurisdictions project an increase in industrial demand in the next decade compared to the historical trend. And a few factors are driving this expected growth, including the build out of data centers, increased industrial electrification from existing and new industries. And Texas is already well on its path and ahead of the curve relative to other jurisdictions. So to meet this industrial demand growth, a build out of supply will be required. But over the past decade, Canada has lagged behind adding wind and solar to the grid. The chart on the left shows which countries have increased solar and wind relative to 2015 levels. And as we can see, Norway and Australia have grown by more than 4 times. And the numbers at the end of the line show the cumulative growth in capacity, with the US adding over 200 gigawatts. The chart on the right breaks down the Canadian provinces included in this study, where we see that most growth has happened in a short period of time in Alberta, driven by corporate power purchase agreements. But this progress has stalled under present policy as well as market conditions. Elsewhere in Canada, the build-out is starting to move, and Indigenous leadership and Indigenous communities are at the center of this. The build-out of electricity generation and transmission is presenting a significant opportunity for Indigenous nations, who are now the largest asset owners outside of crown corporations and utilities. And this is already happening across Canada, where nations have equity in hydro, wind, solar, and battery projects. We recently saw an announcement today where in Ontario, all the capacity projects had 50% or more Indigenous equity. And the First Nations Major Project Coalition estimates that Indigenous ownership could unlock over $17 billion in equity, building on momentum across all 4 provinces, including in this benchmarking study. Another thing that was published this week is a case study for Indigenous ownership and transmission infrastructure that can be found with our Indigenous case authors on our website. Now let's move into the benchmarking results. Our research and interviews with investors and experts led us to 6 metrics that speak to the following questions. Is there sufficient grid infrastructure to deliver on low-cost electricity from distributed renewables to industrial projects? Is there a market for renewable investors, and are the rate incentives to support industrial customers long-term competitiveness there? And is there a stable policy environment that reduces risk for investors? This is a snapshot of all the results and all of the metrics and jurisdictions. And what we see here is together as a package, these metrics influence the jurisdiction's attractiveness for investment in both wind and solar projects, as well as industry. We group these jurisdictions with similarities together. So the most relevant comparisons are between Canadian jurisdictions and their international peers. So for example, Alberta is compared to Texas. We will go over these metrics in the coming section, but you'll have the opportunity to review the results in detail in the embargoed copy and the full report. So let's start with the first metric of energy planning. In the past decade, when demand was flat or had very modest growth, system planners adopted a conservative approach, and rightly so, to avoid the risk of overbuilding. But as we enter this era of increasing industrial demand, using conservative approaches and assumptions when demand is expected to rise can create a planning gap. The combination of this planning for less growth and a rapid increase in demand creates a risk of underbuilding. And this signals to investment both on the supply and the demand side that growth is not expected. This chart shows this gap of underplanning for each jurisdiction. I'll just draw your attention to the illustration on the left, where the bottom wedge shows the official system plan. The orange line shows 50% level of industrial projects asking to connect to the grid by 2035. And we pick this 50% to indicate that not all industrial projects that are asking to connect to the grid will be built. And the blue bar indicates the gap between what the planners are expecting and what the demand, even if half the industrial projects waiting in the queue get built. And what we see is that in all jurisdictions, there's a level of underplanning that is happening relative to the requests that each grid receives. But this is where variability shows that different markets will use different assumptions and have different degrees of ambition in their baseline to manage the risk of overbuilding. It's also important to note that not all markets have transparent project queues or proposal lists. For example, Alberta is a leader in this space, where the project list is updated on a monthly basis and is publicly available. In Quebec, by contrast, this industrial demand project list is unknown. We only know the total size. So with this planning gap in mind, this creates a real risk of supply constraints, as cautious planning can be rational when each province bears the risk of overbuilding alone, but when every province does it, Canada as a whole misses on economic opportunities. This underscores the role of interprovincial cooperation and then the role of the federal government to bridging existing gaps. But it's not just provinces and the federal governments. Indigenous communities and governments are central actors in energy planning. The next metric is flexibility. We focus on flexibility because we found in our research that a flexible grid is a fundamentally important component for keeping rates competitive. We see flexibility as a key competitive advantage, and it's an area that warrants attention in the national electricity strategy. But how does flexibility keep rates competitive? A more flexible grid reduces the need for intensive build-out to meet peaks in demand. It improves the use of assets that already exist, as the majority of the grid is underutilized most of the time. And it allows for more renewables to be integrated at a lower cost, ultimately freeing up supply and improving grid reliability. We define flexibility to have 5 sources. So a grid can increase its flexibility by either importing through interties, lowering demand during peak times, storing energy when there is abundance of it, and then using it as flexible supply during peak times, or using fast ramping gas assets or hydro generation assets that are flexible by design. And in BC and Quebec, thanks to their hydro systems, those 2 jurisdictions already start as the most flexible electricity systems in North America. So systems without the advantage of hydro have to work to deliver system flexibility. It's not a given. We looked at how flexibility has changed in the last 5 years for jurisdictions that do not have hydro-dominated grids. So in this chart, the y-axis represents flexible capacity from all forms of flexibility relative to peak demand. So in this chart, going up means system is increasing its flexibility, and going down means the flexibility is going down. And what we see here is that grids outside Canada are rapidly expanding flexibility for their systems, where in Alberta, Ontario, there is an opportunity to improve system flexibility. This chart here breaks down the capacity numbers from the previous chart by source, but in absolute terms for all non-hydro jurisdictions. And what we see here is that flexibility is going up, but this growth is predominantly driven by increase in the build-out in batteries and interties. So as I mentioned earlier, flexibility just doesn't happen. It's the result of deliberate government action. And what we find in our research is the need for more flexibility is growing, and that market forces alone are not enough to deliver on this flexibility. There are multiple options to increase flexibility with cost and different leading times. So for example, in Texas, we see that batteries dominate, where in Germany, for example, flexibility is predominantly increased through connecting with other grids. And this flow of power between provinces and jurisdictions boosts flexibility. And this is a space where there's a role for the federal government to support interprovincial power trade. Next metric looks at transmission within a given grid. So as grids become more decentralized, transmission becomes more important. We found that increasing solar and wind generation without the sufficient wires creates bottlenecks that lead to wasted energy, also known as curtailment. There's also a structural shift in the electricity system where generation is becoming more distributed and the cheapest power to produce. But that power may not be where the large loads are. So we looked at planned transmission investment across all 10 jurisdictions in the coming decade. And this chart shows that planned transmission investment until 2035 normalized by the size of each grid. And we can clearly see the variation in how each jurisdiction is planning for investment, with European grids leading transmission and variability across Canadian provinces. So as a proxy of how congested each grid is, we collected data on how much energy from solar and wind is being wasted or curtailed over time. So in this chart, the y-axis starts from the top to the bottom, starting from 0. And if we go, the more we go down, it means more energy is being wasted. And if we go to the right, this means there's a higher share of solar and wind. So if we start from the top left corner, we see that at very low levels of wind and solar, there is typically little waste. But as many systems move to the right, we see an inflection point marked here by the diamond on the chart, beyond which there's a sudden increase in the amount of energy being wasted. So energy is being produced, but it's not delivered. And what the data shows is an interesting finding. This inflection point can happen at different shares of solar and wind. So what this tells us is it's not the renewables themselves, but the structure of the system, including whether there is enough transmission to get the power to where it's needed. So we see, for example, Alberta and UK waste about the same amount of share of solar and wind, around 13%. More than double that rate of Germany, which has a much higher shares of solar and wind at over 60%. So what we found based on this data is contrary to what was believed, higher shares of solar and wind do not automatically lead to more energy being wasted. And then investment in proactive transmission planning is paying off. And so, for example, Texas recognized as early as 2008 that it takes more time to build transmission than it does to build wind. And they knew where the best areas of wind are. So they came up with a policy called Competitive Renewable Energy Zone, or CREZ, that proactively plans transmission ahead of renewables development. This is also happening in New South Wales and Australia that are also planning and building transmission ahead of renewable development at scale with bulk transfer corridors. And improving transparency on where the grid is underutilized or overcongested is a low regret step to allow investment in generation and industrial load to make better decisions. And this is where we see that there is a role for the federal government to support provinces in building out cross-border transmission. I'll now hand it over to Kate to take you through the next 3 metrics.
Thank you, Ian. Okay, so our next metric looks at the investment conditions for renewables for the investors this time as they seek to enter the market. So during our interviews, we heard from renewables investors that they constantly compare jurisdictions against one another, and they'll move capital to where conditions are most favorable. They're looking at how often they get to build, the stability of their potential revenue stream, and the scale of that market potential. And while market structures can impact these conditions, so for example, if you're based in Alberta, there's open access, whereas other provinces have to wait to procure power. But really what matters here is the combination of these factors, and any market can actually be competitive. We see that policy itself impacts the outcomes of this. And so, for example, in the procurement markets, predictable procurement cadence can help in the medium term to make the market more attractive. So we took this concept on our next slide, and that so the concept of an attractive market, and that will, yes, thank you. And the upper right-hand part of this figure therefore represents this position of having frequent access with high price certainty, and the size of the bubble on the chart is proportional to the market scale. So that's kind of the most desirable portion of the chart. Over the last 5 years, no Canadian jurisdiction has yet maximized all three, although what we see is things are changing. BC, Quebec, and Ontario, they're awarding contracts via competitive procurement, and these are typically secure contracts and long-term, but the procurement calls themselves only recently became more frequent, particularly in BC and Ontario after a long pause. Alberta, meanwhile, the investors can enter whenever they can secure a grid connection, but price uncertainty is much lower. And we're typically talking about relying on corporate power purchase agreements, as I mentioned earlier, to support and stabilize returns for the short to medium term. What we see in our international peers, however, is they're using policy to enhance price certainty. So, for example, the UK, German, and New South Wales markets offer contracts for difference or other price underwriting mechanisms, which give investors that improved price predictability. And these are particularly interesting when they're structured as two-way contracts for difference, and those can also benefit consumers as well. This is an area where Alberta's done a bit of experimentation in the past. Okay. Our benchmarking found overall that more predictable and coordinated procurement across Canadian provinces can increase attractiveness to international investors. And given the prevalence of crown corporations, Canadian markets already perform well when it comes to price certainty, but they're less predictable for international investors to enter, particularly those used to other market types. When procurements do happen, Indigenous shared ownership and partnership have become standard practice in competitive bids. You heard an example from EAB earlier, but there's examples from BC, from Quebec, and from the other provinces of 50% ownership as well there. And it's not just provincial policy that impacts procurement competitiveness. There are also federal policies that impact outcomes. So trade or domestic content rules, investment tax credits, and support for overcoming barriers to finance for Indigenous partners are all important. So the next metric looks at industrial rates and modernizing those rates to manage as peak demand grows. So our interviews found that industrial investors want access to clean electricity, but they're increasingly concerned that rapidly expanding supply will drive up electricity rates, impacting their competitiveness. We know that the grid must be built out to meet the growing peak demand, and anything that we can do to reduce the peak during the highest demand hours and defer costly upgrades over time can help keep rates lower for all consumers. Industrial demand response and flexibility isn't particularly useful for a system perspective due to the scale of the potential and the responsiveness of industry to signals. And these discounts or payments directly also improve the agency of industry over their input costs, improving industrial competitiveness if well designed. So we looked across the jurisdictions that we have, and on this slide we see the data on both bill savings for customers on one axis of the matrix and the contribution of such efforts look towards reducing the system peak across the network. So bill shaving peak in terms of megawatts versus percentage bill savings, basically. The top right corner represents high savings to the customer and to the system. And the well-designed industrial rate incentives compensate industry in proportion to their contribution. Canadian provinces already use these tools ahead of many of peers in this study, which is a real strength, but there's also still further room to grow. Each province incentivizes industrial flexibility at peak times in different ways. So Quebec's doing so directly through interruptible load contracts, Ontario through lowered electricity fees via the general adjustment charge, and Alberta through its incentives to reduce transmission charges during peak times. So our findings show that compensating industry for peak reduction is a well-established and effective approach. Just as one example, Ontario managed to shave 1,500 megawatts from its peak via such methods. But design also matters. So if you're targeting the biggest annual peaks, that gives you far more system cost savings than spreading those incentives over just the daily peak hours. Our findings also show that as grids modernize, flexibility is no longer about just turning things off. It requires industries to invest behind the meter in storage or other controls to participate meaningfully. The next metric looks at the extent to which jurisdictions offer clean electricity investors predictable climate policy, coming through strongly in our interviews. Though clean electricity technologies are increasingly cost competitive, policy still matters for investors in both clean electricity and electrification, especially the predictability of that policy. So how is climate policy influencing decisions today? Well, there are two key ways. Multiple experts highlighted in our interviews how legislated targets function as a North Star for the transformation of energy systems by helping align decisions by investors, utilities, and system operators. And also carbon pricing, feed-in tariffs, technology standards, and tax incentives directly improve project economics for clean electricity. Meanwhile, unpredictable policy changes in targets and incentives can increase financing costs for projects and hurt a jurisdiction's competitiveness for investment. So we based our assessment on this metric on the two indicators: policy certainty on the books, based on the existence of binding long-term decarbonisation targets and implemented policy instruments, and the extent of historical policy stability over the past 10 years. And what we see is about half the jurisdictions, so Germany, BC, UK, Quebec, and New South Wales, provide relatively high levels of certainty compared to Alberta, Ontario, and Texas, with relatively lower levels of certainty, and Norway and Washington somewhere in the middle. What we took away from this work is that, firstly, clarity and predictability are key to investor confidence, especially at this moment of great economic uncertainty worldwide. The second was really the importance of policy collaboration between different orders of government. Jurisdictions scoring high on this metric tend to collaborate and align their targets and policy instruments with those of higher level governments, for example, Germany and the UK with the EU. In contrast, federal policy reversals in the US adversely affect policy certainty. Although in states like Washington and Texas, their own policies have been fairly stable. In Canada, meanwhile, the May 2026 MOU implementation agreement between Alberta and the federal government promises greater collaboration and policy stability for Canada's industrial carbon markets, but it comes at a cost of a lower headline carbon price and stringency there. So this brings us to another finding from this analysis. Across all the jurisdictions, we saw that carbon pricing is the primary instrument for mobilizing investment, both in clean electricity and industrial electrification, which sits behind and drives it. So, on to recommendations. The provinces are the primary actors in electricity, and rightfully so. But our electricity expansion now has national implications in terms of economic growth, in terms of energy security and competitiveness. These all depend on it. So our federal government does have distinct tools and responsibilities to support provinces in the build-out, as we see on this diagram. This can be about reducing barriers, it's about sharing risk, and it's about sending those clear investment signals. Especially as each province only captures part of the benefit from cross-border cooperation on electricity while bearing much of the political, financial, and planning cost. So we took this and we combined this with the work shown thus far, and this led us to the following policy recommendations. We start by recommending that the federal government should support new cooperative processes for interprovincial energy planning. This requires pragmatic near and longer term actions. So in the shorter term, that means supporting investment, supporting information sharing and goal setting, including an evidence base that's shared on national electricity demand, covering sectors such as artificial intelligence and critical minerals, where a federal strategy directly shapes or impacts electricity needs. It also means developing clear guidelines for how costs and benefits of interprovincial infrastructure get allocated. And here we can draw on models and lessons from places like Australia and Europe. Over time, Canada would likely need something more durable, a coordinating body or bodies with real accountability for planning and incentivizing efficient regional operations. Beginning with regional cooperation, however, building trust and shared methods can help us to start there before scaling up. So our research finds benefits from grid investment spill beyond borders. So where grid investment delivers net benefits for Canada as a whole, there's a real case for federal risk sharing. Our second recommendation says that the federal government should selectively deploy the national balance sheet to support anticipatory grid build-out. In concrete terms, we recommend the federal government develop a national test to determine when and how much federal support is warranted. This could help standardize cost-sharing principles and distinguish projects where financing support is sufficient from those that justify deeper fiscal commitment based on their national economic benefits. In parallel, the federal government should scale up its financing tools. We see the Canada Infrastructure Bank as a good foundation, but Canada's equivalent in Australia, for example, committed twice the budget for a system delivering a third of the power. There's room to do more, particularly where some of these tools also support Indigenous equity ownership and true partnership in grid development. So doubling Canada's grid by 2050 requires investors, utilities, and supply chains to make long-term commitments today. So the federal government should also build long-term policy certainty for investors by moving forward with strong, flexible, clean electricity regulations. This means that the clean electricity regulations should anchor expectations that new supply will be predominantly clean. They should also recognize a real but limited role of gas in peak management without crowding out, for example, the other sources of flexibility we mentioned earlier, like batteries. And this can help make these regulations durable enough to provide the planning horizon investors need to choose Canada as the destination for their clean electricity capital. Flexibility itself is one of the most powerful levers, as we showed, in keeping electricity rates competitive over time. For our final recommendation, we therefore recommend that the federal government should make system flexibility a strategic priority. They should use their investment levers to help scale clean industrial demand flexibility on site. In real terms, this means embedding flexibility as a priority across programs. So right now, storage, grid modernization are eligible for investment tax credits, the SREP program funding, and Canada Infrastructure Bank financing. But we recommend the government go further, explicitly prioritizing clean projects that increase system flexibility within these programs rather than treating flexibility as incidental. And on the industrial customer flexibility side, there's still untapped potential, and it'll only grow as industrial demand scales. So we recommend the federal government use its tax tools, so that's capital cost allowances, clean electricity, clean technology investment tax credits, to mobilize industry investment in on-site equipment, storage, and process upgrades that enable the users to shift their demand away from peak periods. And this demand-side flexibility offers a rare triple policy win, reducing pressure on the grid, lowering system costs, and improving rate competitiveness for the customers. So together, these package of 4 federal policy recommendations help set conditions for provincial-led action as they seek to double the grid and build on Canada's competitive advantage to attract capital. I'm going to open thank you for listening today, and I'd like to open the floor to your questions. We have a Q&A, so please put your questions in the Q&A section so that we'll be able to get to those and answer those. Thank you very much for your time.